Hi everyone, come on in, make yourself comfortable. We'll kick off in about a minute. So come on in and get set up. Welcome along everyone. We're just going to give it another 30 seconds and then we'll kick off. So come on in, make yourself comfortable. All right, we're on time, so we'll get started. Welcome to today's webinar on maximising your retirement savings. My name is Jeff Thurek. I'm a director of Evalesco, and I'm very pleased today to be joined by my friend, colleague, and awesome advisor, Melody Edwards. Welcome back, Mel.
Thanks, Jeff.
And also important to say congratulations on 8 years with Evalesco today. That was, those of you following Evalesco on Facebook, you might have seen that post. So well done on making it through 8 years.
Thanks. What better way than to do an awesome webinar?
That's right. So I'm really excited also to be coming to everybody today live from Evalesco's new HQ in Bond Street. So I'm here all by myself today, and I'm looking forward to being joined by a few of the team in the next few weeks, and then welcoming clients to come and visit us in our new office in the next few weeks or months, or hopefully sooner rather than later. And Mel is at home and maybe going to be visited by some little people at some stage, but we'll see how that goes. I'm just going to share my screen, and we've got some slides to run through as well. So I'd like to let you know that during today's webinar, you'll be on mute and your video is also off, so we can't hear you or see you, so feel free to move around. We do encourage you to ask questions as we go through, and you can do that by clicking on the Q&A tab, which is down the bottom of your screen. We'll try and get to those questions as we go through, or definitely at the end of our chat. Most of our conversation today will be about general financial strategies and superannuation. So I'm going to provide you with this general advice disclaimer, which just says that even though most people on our call today are clients of Evalesco, we don't know your personal situation at the moment. We're not taking that into account. So this webinar is not personal advice. If you would like to discuss it further, please contact myself or Mel or your advisor to talk through. So today's agenda, we're going to be discussing some pointers, some key considerations for planning for retirement. And then we're going to go through the recent changes to superannuation. And we're going to talk through a little bit factually by the numbers. So these are changes that have happened over the last couple of years. Then we're going to focus in, and Mel's going to take us through a couple of case studies on how we've seen clients putting in practice some of those changes. Touch again on a couple more changes that have come through, because there have been a fair few. And then finish off with a discussion around superannuation for women and some strategies to boost that gap that is still occurring. So to kick us off, Mel, can you share with us some of the key considerations for people when they're planning for retirement?
Sure, thanks, Jeff. So these are a few questions that we often get from clients who are thinking about retirement, or putting some thought into what that might look like. And so I'll go through each of the questions and a few sort of pointers for each aspect. So the first one, how much am I going to need in retirement? And this one is the most concise answer is how long is a piece of string? It's all different for different people have different priorities. So it's really about looking at your ideal lifestyle, what you would like to be able to do, and how that differs from what you're currently doing. So if you're planning to do more travel, more entertainment, or hobbies, then that might increase the amount of money you might need to fund your retirement. Conversely, if you want to, you've done all your travel and you want to more or less just settle down and move out of the city, you'll find costs will come down, and your retirement income might not need to be as high. So going through that exercise and really tailoring it for your circumstances will give you the best idea of what's the goal that you're moving towards.
I think that's the key, isn't it? There's some guidelines out there from different people, and different people have different views, but we always find that there's such a range when talking to clients. For some people, they want a lot and they can afford to do that. For some people, they're happy to live a pretty modest lifestyle, and the number is quite different. So there isn't one size fits all to that, for sure.
That's right. I think as well, some people use as a starting point, 70% of your current income, that sort of caters for the tax that you're already paying. Most income, once you stop work, will have little tax or be minimal tax at all, no tax at all. So that's a good starting point.
Yeah, absolutely.
So in terms of planning towards a retirement, sort of off the back of that, again, figuring out what that retirement looks like for you, and then what that would actually cost to provide. And then when you figure out that much, you can work out how much it is that you need to give you that income where you are now, and then the gap between then and now, depending on, again, the time frame. So a lot of variables, but when you have those figures, then it's a little bit of projections around how much do you have to save. Is it reasonable to achieve that in the time frame that you're aiming towards? And if not, then what levers do you pull to try and maximize that outcome? What are you willing to compromise, whether it's spending less now, spending less in retirement, working longer, trying to earn more? There's a few different factors that can be, some will be more palatable than others. And that's where, again, it's about tailoring it to your needs and your circumstances. So I think in amongst that as well is making sure that you make use of the time that you have, because the most valuable tool that you have in your toolkit is time, and being invested in the right things, in the right mix, to maximize the return, but also make sure that you're not taking any unnecessary risk to get there.
Yep, makes sense.
And also off the back of that as well is while you're still working, making sure that you have that safety net around, protecting that income. And that's the most powerful thing in terms of accumulating wealth. If you don't have that income coming in, you can't grow your wealth. So protecting that and providing that safety net gives you security that you're going to meet your retirement goals regardless of what happens.
Yeah, and there's some really important stuff around that, isn't there? There's lots of studies which suggest that most people don't actually get to retire at the time of their choosing, and that's through their own ill health, through losing a job, through ill health of a loved one or somebody else that you need to take care of. So I guess all the points that you talked about then, Mel, come into play there, because you want to get started earlier so you can be ahead of that in case something happens, but also having insurance in place, having some savings buffers in place to cater for those types of unexpected, but I guess not so uncommon things that can get in the way for people.
That's right. And I think one of the things that they've shown as well with investor biases is, and in just human nature in general, is when people think about themselves in 5-10 years time, pretty much everyone is going to think of themselves in a positive light. You don't expect things to go south, and you're not planning for things to go south. So it is hard to visualize that, but it does happen, and we see it, often. So it's about being, having a plan that encompasses all those curveballs.
Yep, absolutely.
So in terms of planning for retirement, is superannuation the only way to go? And it's not the only way to go. It's basically, if you, it's one mechanism to help fund retirement, and the main positive with super is that it becomes a tax-free income stream. No capital gains tax, no income tax when you actually start drawing on it to provide a pension payment. So it's a very powerful powerful structure to fund retirement. But especially if you are starting retirement before being able to access super, you will need to be able to use other income streams to all sources of income to live on. So anything that is a passive income stream where you don't have to do too much to get it, like a investment property that has no debt or a share portfolio that you have in your own name, that will generate an income for you, can provide for your retirement. And depending on your assets and income as well, once you reach age 67, you may get access to the age pension, which is also another supplement to provide for your retirement income. So obviously with the tax benefits from super, that's a good way of getting a bulk of your retirement income tax-free. And another consideration when it comes to things like rental income is that it may not be enough to meet living expenses, especially if you don't have tenants or if there's a competitive rental market. And if you do need access to a lump sum, you can't sell a room to get access to that. So there's a bit more of a liquidity issue there.
Absolutely.
And what actually happens when you reach retirement. So it is a big transition, a big step for a lot of people. So not one to be taken lightly. It's always good to start planning early to ensure that you're maximizing your entitlements, minimizing tax implications, getting things in order so that you're not making decisions in a rush, or being forced to do something that is not necessarily to your benefit. So the sooner you sort of start thinking about it, start talking about it, start planning it, the more confident I think you'll feel. We find clients feel going through that transition. So when they actually take that final step and walk out of the office or walk off, get their final paycheck, it's not a daunting experience. I think also what really is important to know is that when you do stop work, a lot of people who their identities are tied to their work, it's been a big part of their lives for a good 4 or 5 decades, depending on how long you've been in the workforce. So I think it's also important to set up your activities, your plans around what life looks like beyond work, and get them in place before you actually take that step, so that you have things filling up the gaps. Mm-hmm. Yeah. In terms of accessing super, again, there's a few rules around when you can access it and how you can access it. So as you get closer to retirement, access becomes more unrestricted. And while you're still working over the age of 60, generally, you can do a transition to retirement pension where you can draw up to 10% from your super as an income stream. It's received tax-free, but you'll have the income and the capital gains within super is still taxed. So it's not the full benefit that you would get once you're fully retired. Once you hit age 65 or you stop work completely after age 60, then you can access it without any restrictions and begin to draw a pension of your choosing, subject to the minimum requirements. So
that's where those, your thoughts, comments before about other assets with passive income streams. So if you wanted to stop work or scale back from work a little bit before 60 or being able to access your super, it's good to have some other income to draw on. But if you're getting closer to that age, or you're willing to work or planning to work up into that age, then superannuation is that really fantastic tax effective environment that you want to really maximise the benefits within there.
Absolutely, that's right. And in terms of spending more or less in retirement, so again, it depends. Depends on the person and depends on your goals. Some people will spend more and some people will spend less. I think generally what we find is that the initial years of retirement, people, tick off the bucket list, do all the travel that they've been saving up for when they had more time, and do a lot of it while they're still young and healthy. And then after, a few years, that will tend to taper off and they'll go back to what they were spending before. and then after, as they age, then health costs will increase. So we find that sort of spikes up again to cover those additional expenses. So more or less a V shape, but no hard and fast rule there.
People are typically living so much longer in retirement now. So, you know, if you're looking at somebody, pretty common, or now and into the future, it'll be pretty common for people to retire at 60 or 65 and live until they're 85 or 90. So, you know, that's a long period of time, and a lot of changes will happen in that time. So it's not, you know, not realistic to expect it's going to be one level of spending over that time or one level of need. So that, you know, spending patterns will change, and therefore the plan needs to allow for that. Longevity is a really important part of it, but I guess the plan needs to also be able to adapt to that change in spending habits.
Yep, absolutely. And that's where that continual review of the plan review, and also looking forward, you know, as much as we can predict the future and cater for anything that we're expecting. It's that, you know, having that continual review process will make sure that it's the plan is aligned every step of the way.
Yeah, absolutely. That's great. So there are some really key considerations, I guess, to frame the conversation around some of the slightly more technical aspects of super changes. But a good place to start is thinking about those points that Mel's raised there. So I'm going to move on. I'm going to talk about some of the recent changes. And when we say recent, they're over the last couple of years. There's been a fair few that have come through specifically this year, but over the last few years. So people often talk about super being really complicated and always changing, and there is some truth to that. I think sometimes it is probably overstated, in that, you know, I guess the main framework has been pretty consistent for a while. It's just tinkering around the edges with some of the rules, which we're going to go through today. Over the last couple of years, there has been a fair few changes, and most of them have been fairly positive to make it, I guess, easier to get more money into super, more flexible in terms of how you access your super, and generate income in retirement from your super as well. So I'm going to go through these changes reasonably quickly, and then we're going to, as I said, Mel's going to take us through a couple of case studies about how some clients have used some of these changes in recent times. So the first change that has come through on July 1 this year is superannuation guarantee contributions has increased to 10%. So that is now employers are mandated to pay 10% of your salary if you're still earning an income to super, subject to those restrictions around higher incomes. Important to know that most of the time this will be added on top of your existing salary, but there has been some cases where employers have taken the 0.5% increase from take-home pay, so your total package has been the same. So that's just something to look out for and be aware of as well. That one's reasonably straightforward and a great benefit. They are planning to continue to build that towards a 12% ultimate goal of SGC contributions. The next change is increased contribution caps. So this is how much you can put into super each year. So the contribution caps were brought in several years ago, and they've tweaked those a little bit in recent times. So this year, the concessional contribution cap has increased to $27,500. So concessional contributions are for those tax deductible contributions, also including your SG or employer contributions. So that's where people are typically salary sacrificing or making those tax deductible contributions. The cap for non-concessional contributions, which is your after-tax contributions, has also increased up from 100,000 to 110,000 for this financial year and onwards until further notice, which is great. We've also seen increased ages for contributions. So this is a really positive one. Again, factoring in people living longer, people working longer, giving more flexibility for people who are staying in the workforce to make contributions to super and I guess in some ways catch up a little bit if they haven't started earlier. So the rules now are for all ages up to 67, all types of contributions can be accepted. So previously there was restrictions once you got past 65. They've lifted that up to 67. From 65 to 70, sorry, from 67 to 75, they've also tweaked some of the contribution rules as well. So anyone can receive superannuation guarantee contributions once they're over 67 now. Anyone else who's over 67 and would like to make other types of contributions, you would need to meet the work test. So the work test means you've got to be working at least 40 hours over a 30 consecutive day period in the financial year the contribution is made and before the contribution is made. So that again caters for those who do decide to continue working, gives them the flexibility to make contributions where they wouldn't otherwise have been able to under the previous rules. If I missed anything there, Mel, or any comments on that?
No, you've covered everything. With the work test, though, it's good to note as well that in the May budget that came out, they did propose removing that requirement for people aged 67 to 74, which would be a great outcome for open up a lot more possibilities for people who didn't want to continue working and still want be able to contribute to super, and that's yet to be passed into law, but hopefully we'll get that before the end of this financial year.
Yep, absolutely. So the other one that recently came in was the downsizer contribution has been extended to younger ages. So now people who are 60 and older can make contributions based on the downsizer contribution rules. So Mel and I did a webinar on that earlier in the year, which I'm sure you've all seen and memorised all the rules and options around that. But maybe Mel, can you just give us what's the crux of the downsizer contribution and how that works and why it's great that it's now down to age 60?
Yes, that's right. So previously, the downsizer contribution can only be made for people who are over the age of 65 when they sold their principal home of residence that they've owned for at least 10 years and could contribute up to $300,000 each if it was, for a married couple or a spouse, a spouse couple. So now that they've reduced that age, people who are now 60 and older can get access to that downsizer contribution, which is another type of contribution on top of the standard contributions that are allowed into super.
Yeah, so it doesn't count against your non-concessional or concessional caps, which means it's the opportunity to put more money in on top of that as well.
That's right.
So that's one, certainly. I think, downsizing has been a common thought for a lot of people around just the general strategy of selling a bigger family home and moving to a smaller place. So that was why this strategy, this, I guess, piece of legislation was brought into play to help facilitate that and make sure people are doing good things with that money by putting it into super where it fits as well.
Yeah, sorry, just to clarify, the age 60 doesn't come into effect until 1 July 2022. So not this financial year, next financial year. So don't go selling your house yet. That's
where it gets, like with all these things, we want to have the time to plan for it and think about it. So it's an important one to start thinking about. Thanks for clarifying that. So the next one, which was not a new change, it was actually brought in 2019, but I think this is one that us as advisors get a little bit excited about because it creates some fun planning opportunities and, we can crunch some numbers and reduce some tax. So that's the carry forward rule. So that's where you're able to carry forward unused concessional contributions. So concessional contributions being those tax deductible contributions. So for people who have a superannuation balance under $500,000, you can bring forward up to 5 years of unused concessional contribution. So that's quite a lot. So that means the previous limit was 25,000. If you hadn't contributed up to 25,000 for the previous years, then you're able to bring that forward into 1 year. And as I said, that creates some really good planning opportunities for topping up your super, reducing tax if you're selling assets or triggering capital gains potentially. There's some good use of that money then to contribute that to super to reduce some of your tax. So it's a good strategy to keep in mind. And it's probably one that's underutilised a little bit, but we're seeing it more. And in Mel's case study, certainly going to touch on how that factored into it as well. And then the bring forward rule. So the bring forward rule is around non-concessional contributions. So the big change, two changes to that really are extended to people who are age 65 and 66 now. They're able to bring forward. So that means you can bring forward up to 3 years worth of non-concessional contributions into 1 year. So with the non-concessional contribution cap increased to 110,000, you can now bring forward up to 330,000 in one financial year to contribute into your super. So that's again helping people slightly older to get a little bit more money into super. We'll touch on a little bit of that as well. Another change has been the transfer balance cap has increased to 1.7 million. So that's the amount of money that you're able to transfer from your accumulation phase of super, so where you're building up your assets in super, to the pension phase when you go into retirement and start to draw down on that. So that 1.7 only applies for new pension balances. There are some sort of transitional rules for people who already had some money in or had used their cap. But for people who are now looking to move into retirement, they can transfer across up to 1.7 million. Anything in super over that would need to stay in the accumulation phase. And the benefit of obviously the pension is, as Mel talked about, that's tax-free once it's in the pension phase. Anything to add on or clarify on those, Mel?
No, that's all good.
And then another good one is the pension minimum. So the amount of money, there is a minimum prescribed amount that you have to take out of your pension each year as a percentage, starting at 4% when you first move in retirement and increasing in 5-year increments. That at the moment was brought in last year due to COVID to reduce and be able to halve what you need to take out to try and help people to protect their balances. And that has been maintained for this financial year as well. So what that means is if you would normally have to take out 4% of your balance, you only need to take out 2% for this financial year. So that gives some good planning opportunities as well. By all means, if you need the money and from a cash flow viewpoint, you've planned for it and you want to take out more than the minimum, then you should. That's great. But it does give the opportunity to think about reducing that a little bit. So that's it for the facts. Now Mel's going to run through, a case study, a couple of case studies about how some of those strategies have been put in place. And whilst we're going through this, please do listen along to Mel. But if you've got any questions, then post them in the Q&A section and we can try and address it as we go through.
Thanks, Jeff. In this particular case study, this client is currently 64 and retired, has an investment property with no debt, and would like to maximise his tax-free investments and provide for his retirement income. So, as we mentioned, super being very tax effective once you convert it into a pension, and investment property would be, taxable income. And also not enough for actually meeting retirement income needs in this instance. So by selling the investment property, he'll be triggering off for capital gains. So one thing we looked at was what unused carry forward contributions he could make to maximise the tax deduction that he could get to offset that capital gains and reduce the tax on that property sale. So this is assuming that he sells it next year in 2020 financial year 2022. Because he stopped work, he's got a couple of years of non-tax deductible, no employer contributions going in, so the full unused contribution is carried forward, and so accumulating all of that across the year. So as you can see in the table there, in 62, 63, there was some contributions made that would have been from his employer, and some that, so there was a leftover of that cap, of that 25,000 limit for each of those years. And you can accumulate up to 5 years, as Jeff mentioned. So essentially, if you sold the property, if you sold the property in 66, which is what I've projected, when he's 66, he's still got access to put the money into super without meeting a work test, and will have access to essentially the carry forward unused caps from the previous 4 years and the current 2023 cap as well. So if you go to the next slide, that would give him a total of 77,500 of the carry forward unused contributions, the current year cap of 27,500, and also because he's under 67, he can bring forward 3 years of contributions as a non-concessional or after tax contribution, which is 330,000. So that would enable him to get 435,000 contributed into super, and his tax savings from that offset again of the deduction against his capital gains would be about $19,950. So a really good outcome to boost his super and minimize that tax and give him more in that tax-free environment to provide for his retirement income.
Yeah. So there's a fair few moving pieces there, but that's a great case study, and it's a real life one that covers off a number of the different aspects of the changes that we brought in, because he's able to access some of that now, a little bit older, some of the other the carry forward and the bring forward contributions, which you may not have otherwise previously been able to access, which is a massive benefit. And it's also a good proactive strategy because you're thinking about the timing of those things. So he's obviously, sought the advice, and you've been able to have that conversation and get ahead of it, so that you're prepared for when the right time comes to take those actions and make the most use of the assets available.
That's right. And, as you mentioned, because it is a forward-thinking strategy, is something that if his super does really well in the meantime and he's getting close to that 500,000 limit, it may be that we bring forward, it might mean a review and a bring forward of that transaction to see about what the cost benefit of selling earlier and would mean for him versus postponing it as well. So it's just, again, as being able to reflect with the changes that happen in real time and make sure that everything is still appropriate. We're still maximizing what we can when we can.
Yep, that's great. So as I said, if there's any questions about any of those, then shoot them through and we'll move on to the next one.
So this one is for the downsizer contribution. Again, in a bit of forward planning in this one to take place in the next financial year, which will be, that should say financial year 23, because that will be in July 2023, to sell their home and move up the coast for retirement. A bit of a sea change, and also it would mean that there's a little bit more left over from selling out of the city and buying a home up in regional New South Wales. So we estimate there'd probably be a leftover of funds of about 650,000, which could be utilised as downsizer contributions for each Arthur and Charlotte, and then the rest to be topped up as a non-concessional contribution into super to maximise what goes in.
And so that means that when they move into retirement, there's an extra 650,000 in that tax-free environment that they're generating an income from, and hopefully they're living in their nice home up the coast, not rattling around in their big old family home, which is the common concern or common consideration for a lot of people. And the benefit for them is they don't have to wait until they're 65 to make this move. They can do that with some room to move and some time to plan for it, now that those changes have come into effect and brought the access age to that down to age 60 from next financial year.
That's right.
That's great. Yeah, Mel and I were talking about it beforehand, and had some clients recently who have benefited from a number of these changes in a similar way, in that they also moved from the city up the coast and were able to make downsizer contributions. And because one of them was 66, they were able to make additional bring forward concessional, non-concessional contributions as well. So they got the best of a number of the new rules that have been brought into place and timed it really quite nicely to to take advantage of some of those different steps as well. So there are some really good planning opportunities, and there is a bit of flexibility now as well with some of the changes to the ages and the different ways you can move money around with those contributions. So as I was saying, with these changes, you know, sometimes complications because you've got to be more aware of the dates and the timing of things and the ages when you can contribute and getting things done in the right order. But the recent changes have opened up more options, and there's a bit more flexibility there about how you can take advantage of super as well. So I'm just going to touch on a couple more of the changes that have come into play in recent times. These ones have all been announced from the 1st of July. Not necessarily as impactful, but perhaps somewhat interesting. And I guess this one is super stapling, which was part of some recent legislation. So this is moving really more to the opposite end of the spectrum for superannuation than we were just talking about with downsizer contributions and retirement planning. This is more applicable for people when they're starting out and building super. So from the 1st of November, this comes into effect where new employees who don't choose a super fund, most employers now will have to check with the ATO if their employee has an existing account, and this would be known as their stapled super fund, and the employee will have to pay superannuation guarantee contributions into that account. So this is really designed to stop that proliferation of small super account balances and people losing their super when they're moving from job to job, particularly for younger people who are maybe doing part-time work while they're studying, or you know, while they're getting started in the career, moving between job to job and not making super a priority. So I think it's a good move in the main. Some things to be mindful of are you know, lost benefits that may have accrued through insurance that was in a previous fund. There's also the potential that you might get stuck in an underperforming fund. So if you don't think about it, as with super in general, if you're not engaged and you don't think about it, then you can get stuck with a fund which isn't performing or is paying too high a fee. So this doesn't have any qualitative overlay. It's just a matter of this is your first fund and the ATO tells them that's the staple fund and that's the way it goes. But you can still make a choice. So I guess this is probably relevant for more people on our call today to maybe talk to their kids or grandkids about thinking about super when it comes to their first and early super funds and jobs. And the second one, which has been generating a fair bit of press and I think is quite interesting, is the performance testing. So now APRA is required to conduct an annual performance test of My Super products. So My Super was the default low-cost options which everybody had to incorporate as of a few years ago that the government brought out. So they are, as I said, typically default products, and as such, they're not relevant directly to most of our clients or most people on this call, because everybody who's watching here is probably making a conscious decision about where they're putting their money and investing in, so not necessarily default at the moment. But what's interesting is that the ATO and APRA are now taking an interest in trying to make sure that the superannuation pool is delivering good outcomes for clients. So you know, if you think about it, it's a mandated cash flow that is going into these products. The government's making sure that the money goes in there, but hadn't really previously had much oversight, or as much oversight as they could in terms of performance and fee. So the methodology they've come up with is probably a little bit imperfect, but they do have a methodology now, and there's a consistent approach. And they've started by analysing about 80 funds in recent times and came out with the results recently. 13 of the 80 failed the test initially. So they have to communicate to members that they have failed the test and that they need to do something about that. So the methodology is effectively focusing on a net return. So it's the income, that I guess the return generated from the investments less the cost of the fund. So the failure may be due to the fees being too high, or it may be due to the returns being too low, or a combination of both. The ATO has built a tool also called Your Super Comparison Tool, and that's for comparing super products. At the moment, it's only these top 80 that are kind of included in there. Over time, I think the ATO website will become a really good source of comparative data. And even if your fund isn't listed, which for a lot of our clients, their fund specifically may not be listed on there because it's tailored to your own purposes, it'll become a good place to go in and check in, because you can use that as a reference and say, well, this is what the ATO, your super comparison tool says is a relevant return, or these ones are passing the test. How did my fund go compared to that? So I think that's going to become a useful source of data over the next few years. At the moment, the first lot of tests were done based on 7 years worth of data. They're looking to make it an 8-year focus going forward, so it'll be rolling 8 years, which is a reasonable time frame to make some level assessment. So it's not an annual return or anything like that, which is good. So yeah, that's one to watch this space and keep an eye on, but I think it's an interesting development. And the final one is self-managed super funds can now have up to 6 members. So previously they were capped at 4 members. Now you can have 6 members. It's not a revolutionary, world-changing sort of piece of legislation, but it's an interesting one and may allow some planning opportunities. We do see with some clients that they've got their children who they might want to bring into a fund, and allow them some of the benefit of the fee savings and scale that can be derived from investing or co-investing in larger assets or more diversified pools of investments, which can certainly add some benefits there. So that's something worth thinking about, and one of the benefits of that change, I suppose. Any thoughts or anything to add on any of that, Mel?
No, I think you covered it off nicely.
Okay. So they're pretty much the changes that have come into effect. And the last topic we want to talk about really is women and super. And the reason this is important is that we're still seeing and hearing all the reports and studies showing that on average women are retiring with so much less super than men. So we want to think about what can be done and how we might approach that. So over to you on this one, Mel.
Thanks, Jeff. On average, women end up with a third less super than men at retirement. And obviously that means less options for them in terms of and opportunities in terms of living the lifestyle that they aspire to live and lead in retirement. And one of the key factors around this gap is that super is not typically paid on parental leave, and as women take most of the parental leave, it's about 99% at the moment, they take the bigger financial hit. So there's a report that came out recently that this is just based purely on the government paid parental leave. So this is not even including parental leave from private companies. But Australian mums have missed out on more than $1.6 billion in retirement savings in the last 10 years based on the amount of time, the amount of parental leave that's been taken by women and the lack of the superannuation contributions on top of that. So another factor when they are out of the workforce, it also reduces the average income over their working life for women. So typically it takes a bit longer to get back up to speed once the kids are grown. They're starting, they're sort of taking a step back in some cases in their career ladder. So getting up to that peak income earning is delayed, and the amount of time that they're earning more is also shortened. So when they get closer to retirement as well, they're often what we call the sandwich generation, taking care of aging parents, which often can lead to reducing work hours as well to be able to cater for that, and reduction of work hours and reduction of income then also feeds into that lower superannuation contribution and balance. So one of the things I think there are some contribution strategies or some strategies available that can help plug that gap a little bit, and especially where women are partnered, and so the husband might be continuing to work through all those gaps in work for the female, for the woman. So one of the things is super splitting. So one thing you can do is split contributions that are made into one spouse's account to the non-working spouse, to try and even that up a bit. So they're both getting something going into each super balance. And another type of contribution as well is a spouse contribution, which you can get a tax offset for if the non-working spouse or low income spouse is below a certain threshold, and that will give a bit of a tax benefit for the working spouse who's contributing on their behalf. So every little bit helps, I think, in this space to help plug the gap. And I think it's also being just aware and knowing that you know, this is an outcome of taking time off work. And you know, I'm by no means saying don't take time off work, because you know, having gone through you know, the joys of parenthood and bringing in life into the world, you know, there are definitely benefits for having that time with your little ones. But it's about making the conscious decision and planning around that to try and make sure that you know, you've got strategies in place to give you options in the future.
Absolutely. And I think it's you know, with everything with regards to super and investing, the earlier you start, the better. But if you can approach it that, you know, if you're earning good income and have some savings capacity earlier on, then it makes sense to increase contributions through salary sacrifice or that type of thing earlier on, so that you get the money in there, and that then has the benefit of compound interest over a longer period of time as well as then thinking about strategies to like these to top it up as you go through.
Absolutely.
So yeah, it's a challenging one, but as you said, Mel, it's really important if it's in our minds to think about how we can approach it as well.
That's right.
So we've come right up on time, so we're going to wrap up at 1:15 exactly. So we've nailed the timing there, Mel. If anyone does have any last questions, happy to take, you know, 1 or 2 questions, but otherwise we'll get started on wrapping up. So. So hopefully you've got a bit of insight into some of the changes. As we said, there has been a fair bit of change in regards to super over the last couple of years. So it's worthwhile checking in with your plan and thinking about how they may apply to you. Probably the best way to do that is to have a talk to your advisor to see how that might be applicable to your own situation. If you do have any questions, though, please do send them through to us. This presentation will be available via our newsletter, which will come out this afternoon, and also it'll be posted on our website. So please go there and have a look. Our website has been newly relaunched and updated, so we'd love for you to go there and have a look at this presentation and other useful and interesting articles and resources on our brand new website, and give us some feedback if you have any on that as well. But as there's no further questions coming through, we'll wrap up now, and thank you, Mel, for your insights and joining us today.
My pleasure. Thanks for having me.
Thanks everybody at home for your attention, and look forward to catching up with everybody soon. Thanks. Bye.
Bye.